U.S. cyber insurance market continues to expand, but with the ever-growing threat landscape and potential for heavy losses, the market's future appears to be rife with uncertainty. I'm John Weber for AM Best TV. Here to discuss AM Best's new report on the U.S. cyber insurance market is Fred Eslami, Associate Director, and Sam Hanig, Senior Industry Analyst. And Sam, we're going to start with you. Two trends seem apparent over the past few years. The rate of growth is slowing and more standalone policies are being sold. What does this tell you about the market?
So there are some market dynamics in play being reflected in slower total growth and an increase in standalone policies compared to the increase in packaged policies. The increase in standalone policies reflects an industry-wide trend of carriers trying to reduce or just outright eliminate their silent cyber exposure. While some in the industry refer to this process as improving contract certainty, the end result is the same: eliminating unintended cyber coverage from policies underwritten and priced to cover non-cyber risks. So the natural follow-up is for cyber coverage placement in a policy underwritten and priced for cyber coverage, and specifically for cyber coverage. And this is what a standalone policy is. So that's kind of what we're seeing driving the standalone policy growth. The reduction in silent cyber is fueling standalone policy growth. When it comes to slower growth, what we've seen is that most of the larger companies, the larger entities, have had their cyber placements in place for a number of years now. So they've already had their cyber policies. So what's driving the growth is the small to medium or SME market. Now, this is still an underserved market, but as these are smaller entities, their marginal premiums are going to be smaller. So we're seeing growth. It's just slower than it's been in the past because the larger players have already done their cyber placements.
Fred, do you think the scope of the recent attacks and just the potential magnitude may scare insurers away from this market?
Not really, John. I think that would be an engine for both insurers to provide and customize their cyber policies. And also, because of the increase in the attacks, it's another engine for the companies and future policyholders to get into more buying more cyber policies. And I think, the projections that various reliable market studies provide show that the expectation is that with the increase of cyber attacks, there will be an increase in premiums for insurance companies from low to mid 20 billions by year 2025 and 2030. So expectations is that these attacks are going to be there and are going to be constantly increasing, and this would charge both insurance companies and companies actually to buy and provide insurance.
So are insurers doing an effective job against so-called silent cyber? Sam, what more can they do?
They can continue to work on their contract certainty. We've seen some major writers like Lloyd's and AIG publish public statements asserting they're completely eliminating and moving away from their silent cyber exposure. So continual relooking at their contract language, encouraging brokers and other intermediaries to place standalone policies, and just to continue to look at their contract language. And we're already seeing it. This fuels some of the standalone growth. So I think that the insurers just need to continue their efforts to revise and revisit their contract language to eliminate some of the silent cyber exposure.
With claims still on the rise, Fred, is there any concern yet about pricing?
Pricing, I think the shift towards standalone policies would contribute to better pricing. And we have seen and anecdotally heard from buyers of these policies that prices are getting firmer and moving upward.
Now, the report notes the similarities between a cyber attack and the ongoing pandemic. Sam, could you discuss that dynamic and what should insurers be doing to mitigate cyber losses?
There are a number of striking similarities between the current pandemic and cyber exposure. Both of these risks have no boundaries. They pay no attention to geography. They can both impact supply chains and cause devastating losses for business interruptions. And similarly, both COVID-19 and cyber losses, you can have incurred the harm and not know about it. You can have asymptomatic. You can be asymptomatic for COVID, as well as you can have incurred a breach and not be aware about it, unfortunately, until it's too late, or you've passed on the condition to somebody else. Insurers need to continue to be mindful, especially at this time of increased exposure with so many employees working from home, just to continue to encourage their employees to be cautious, to utilize VPN. This can help mitigate much of the increased exposure that we're seeing from the pandemic.
Now, this report focuses on both the admitted cyber insurance market, but also covers both surplus lines and captive writers. Sam, how do these markets differ?
Well, when it comes to comparing the three markets, all three have maintained very high profitability. What's interesting about the surplus lines market is it makes up such a substantial portion of the total cyber market. And I think that speaks to the complexity of some of these cyber risks that so much of it is placed in the surplus lines market as well. Now, at AM Best, we have access to a lot of the surplus lines financial statement data, and we can do some comparisons. So what we're seeing is really interesting. We're seeing, firstly, that the average premiums for a surplus lines policy are materially higher than the average premiums for an admitted policy. And this is on a standalone basis, just for cyber. So right out of the gate, a surplus lines policy is more expensive, which means it's going to be riskier. In general, prices commensurate to risk. So first of all, surplus lines policies cost more. Then we're also seeing, even though these surplus lines policies are charging more premiums to their customers, they are still incurring worse loss performance. So we talk about this a little bit in the report, but even with higher average premiums, surplus lines carriers are incurring higher loss ratios for standalone compared to their admitted counterparts. The captive market is much dwarfed, to be expected, by the surplus and admitted markets, but is still highly profitable and actually has the best loss ratios among the three segments.
Thank you, Sam. Fred?
Thank you.
Thank you.
That's Fred Eslami, Associate Director, and Sam Hanig, Senior Industry Analyst. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.